welcome to the Money Mile. Joining me today is Navneet Munot, one of India's most respected fund managers. This is part of our series, COVID-19, the New Normal. Navneet is the Executive Director and CIO at SBI Mutual Fund, India's biggest mutual fund. Thanks very much, Navneet. Pleasure talking to you. Navneet, one of the big issues that have come to the fore is liquidity. If I look at it from an investor's point of view, the need to have the availability of money during this lockdown, has been an issue. People are grappling with pay cuts. People are grappling with job losses, the need for liquidity. If I look at it from a investing point of view, from a fund management point of view, we saw recent very unfortunate events where a very, very large amount of money was turned illiquid overnight because of a particular fund not being able to run those schemes. Is liquidity, according to you, both from an investor's point and a fund manager's point, going to be the new normal?
So you're absolutely right. In fact, I always maintain that liquidity is positively correlated with the market direction and sentiments. When sentiments are good, there are more buyers. When sentiments are not good, there are less number of buyers. And whether as an investor or as a fund manager, as an individual investor or a fund manager, you should always keep that in mind. And events like this shows us the importance of the good liquidity management. So for an investor's perspective, I think keeping some money aside in liquid instruments to meet the emergency needs is very critical. From a fund manager's angle, I think what's important is you look at both the asset side as well as the liability side of the fund. At our end, we have always been very particular in terms of, in our fund template, ensuring that there are adequate liquidity buffers available. We look at the stress testing and how liquid the portfolio is because we run T+1 liabilities. But on the other side, we also ensure that there is no concentration on the liability side. And that's why, particularly in the funds like credit risk fund or a small cap fund, where liquidity is relatively lesser, we also ensure that keep certain limits on the per investor investments that we take. I also want to make one point that while liquidity is good and liquidity is desirable, it comes with a huge cost. So let's say you want a very liquid amount of money and keep money in a saving account or in an overnight fund that earns 2-3%. As you take some bit of illiquidity in the portfolio, that delivers higher risk. And if you look at some of the best performing funds over a long period of time, like Yale Foundation or some of the other endowment funds, they basically take advantage of the illiquidity premium that the market gives to you. And that's what is important for the investors. They need to assess their liquidity needs and try to take advantage of that. Not that, I mean, if you keep every money in a saving account or in an overnight, then you won't be able to meet your investment goals. So there's a fine balancing you need to do between the liquidity that you need and the returns that you need to make.
It's always a pleasure talking to you, Navneet. Thank you very much for joining me. And
my pleasure. Thank you so much. And I hope, I wish all our investors and you are staying safe, staying healthy.
Thank you very much, Navneet, and look forward to speaking to you soon again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.